Transactions cost in economies of scale, that is, the fact that certain average production costs decline in the size of a firm, are reasons why financial markets are dominated by indirect exchange via the means of financial intermediaries, rather than direct exchange by means of securities. However, economies of scale are typical to many economic markets, like for instance much of manufacturing. The more specific nature of financial markets is the problem of asymmetric information. Asymmetric information in general describes a situation in which one party in an economic transaction is better informed than the other. Unlike other forms of market failure, like non-perfect competition, it was added to the catalog of sources of market failures relatively recently, about 50 years ago, through the contributions of George Akerlof, Joseph Stiglitz, and Michael Spence, who shared an economics Nobel Prize for this contribution. Unlike other forms of market failure, asymmetric information can never be resolved in a first best efficient outcome. As a reminder, if you don't remember, when economists use the term allocative efficiency, they describe a scenario in which all possible mutually beneficent transactions are made. A simpler way to remember this is that efficiency simply describes a scenario in which there is no waste. Anyone who wants to participate in a market transaction can. Asymmetric information issues, as we will see, are the main reason why financial markets are regulated, although unlike, say, the provision of public goods, the supply of financial services typically remains in the hand of private firms and is not controlled directly by government. There are two forms of asymmetric information: adverse selection and moral hazard. In this video, we will discuss the first, and we will return to moral hazard in the final video of this week. Adverse selection occurs before a contract is made and describes an informational asymmetry about the quality of a good or service. It is also named a lemon problem after a low-quality used car. Adverse selection problems in finance refer to borrower quality in debt markets, overvaluation problems in stock markets, or problematic participants in the risk pool of insurances. Now, George Akerlof's original problem describes a scenario in which a car buyer of a used car cannot distinguish between high and low quality cars. Basically, you look at a car of a certain make and you don't know if it's a good car or if it's a lemon. In this scenario, a buyer would only be willing to pay a price that reflects about the average quality of a car. This in turn incentives low quality sellers to eagerly sell because they know they can sell a bad car for about an average price, but at the same time it will push high quality sellers out of the market. The reason for this is they know they have a good car and they know they cannot earn the price that the car is worth. This is a form of market failure since the owners of good cars do not sell, even though it might be mutually beneficial to do so if only the buyer could tell the difference between cars. Specifically, if everyone knew the quality of a better cars would sell at a higher price, and lower quality cars, lemons, would sell at a lower price. Notice that this is a function of the informational asymmetry, not of whether buyers and sellers know the quality of a good at all. For instance, if no one knew the quality of a specific car, a price reflecting the average quality of a car would be acceptable to buyers and to sellers of cars alike. In financial markets, the most obvious asymmetric information problem is borrower creditworthiness. If you apply, say, for a loan, a lender will know less about your ability and willingness to pay than you do. If lenders charged everyone the same rate, this interest rate would have to then reflect the average default rates across borrower categories. This in turn would set an incentive for lower quality borrowers to apply and more credit-worthy borrowers to stay away from the market. Similarly, if stock prices reflected the average profitability of a certain kind of firm insiders of less profitable firms would be more eager to issue stock than more profitable firms. This is akin to saying that overvalued firms are more likely to issue shares than undervalued ones who cannot recoup their value in the market. Now, how do we solve informational asymmetry issues? Generally, any solution attempts to reduce or remove the informational asymmetry in of itself. In the case of adverse selection problems, there are in principle two solutions, although one is much more relevant in the financial markets context. That first one is screening, and screening simply means that the less informed party tries to obtain information about the quality of the good or services the more informed party is exchanging. This is what typically happens in finance. Banks, for instance, screen the borrowers. The second solution approach is signaling, in which more informed high-quality parties try to signal their worth to the less informed party. To a degree, this does exist in finance. For instance, if you are a firm that's doing well, you probably want to publicize that. But broadly speaking, it is the smaller of the two solution approaches. The prime example of signaling, as a side note, is higher education and its signal value in labor markets. That's what Michael Spence wrote his paper about a couple of decades ago. Now, how does this work in practice? In principle, it would be possible for investors to do their own research or hire a private firm to do so. Ratings agencies like S&P, Moody's, or Fitch, or consumer rating firms like Equifax or TransUnion are privately owned firms that sell information about market participants in the credit space. However, these services are unlikely to generate a comprehensive amount of information, especially in securities markets. The reasons for this are twofold. First, private markets will tend to undersupply information. This is a free riding problem. If everyone did their research homework, better quality firms, for instance, should sell higher priced bonds. They should be higher in demand. Since you can then use the price of a bond as a signal of its quality, few people have an incentive to actually collect the information to price it in the first place. Second, where private provision of information does exist, we typically see a conflict of interest problem. Much like auditors, for instance, the ratings firms are typically paid by the firms they are supposed to evaluate. Specifically in more arcane areas of finance, like securitized loans, the rating agencies have a really dubious track record of underestimating actual default risk, specifically in the pretext of the 2008 financial crisis. We'll come back to that. Alternative ways of creating a better informational environment would be the government provision of information, and this typically comes in form of disclosure requirement of financial statements for public firms. And yes, this is overseen by the SEC, and other types of informational provisions such as bank stress tests, as they are executed by financial regulators, serve the same function. Generally speaking, however, the main solution to adverse selection problems is financial intermediation in of itself. Financial intermediaries, like banks, are at core experts in collecting and analyzing information on borrower quality. Others, like mutual funds, may specialize on stocks or other types of financial assets. By and large, these firms are really traders in information. That's what finance is. And many of them have a focus on non or less traded loans, which tend to generate more profit for banks than something very liquid like stocks. Banks, as a side note, are actually not allowed to hold stocks, but we'll come back to that later. Notice that this in principle can improve the efficiency of financial markets, but it will not create a first best scenario even if banks or mutual funds do the job perfectly well. They don't always do, but even if they did, we would still end up in a slightly inefficient outcome. The reason for this is that collecting information is not free, and the price of the ultimate lending arrangement you make with your bank will be higher than it would be in a perfectly symmetric information scenario, because the bank needs to screen borrowers first, and that's costly. Financial intermediaries are more relevant for households and small and medium enterprises, since information is harder to come by about smaller borrowers than about large firms like, say, Apple. It's also the same reason why smaller and medium enterprises tend to not have access to stock markets. Now, how do financial intermediaries do this in practice? Intermediaries screen possible investment opportunities closely. They relate on information like credit scores, but they will typically ask for additional information like income, or in the case of corporate borrowers, they will screen financial statements, business plans, and so forth. An important aspect of loans is that they are generally secured. There is some unsecured lending, like credit cards, for instance, but the majority of loans, mortgages, car loans, and so forth, are secured. And what this means is that there is some collateral attached in case of borrower default. Having to put up collateral, like a house or a car, in a lending agreement doesn't only compensate a lender in case a borrower defaults. Moreover, it discourages higher risk borrowers from applying for a loan in the first case if they themselves have an understanding that they may not be able to repay or that they may not be willing to repay, and in that case, lose whatever collateral they pledged.